This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
One of the main disposals by taxpayers within the tax year that you're likely to see in an examination question is the disposals now, as we see here in Chapter 13, of shares. Well, shares and securities, but specifically shares. In relation, as you'll see here in Note 1.1, in relation to securities, gilt-edge government securities and qualifying corporate bonds, i.e. corporate loan stock there, then those you have already seen on a list of course of assets that are exempt from CGT. So government securities, qualifying corporate bonds, i.e. corporate loan stock, any such disposals exempt. But the main one where calculations are involved, and as I've said, it comes up in the majority of examination questions, not all, but in the majority, disposals of shares. Now, when we looked at the basic capital gains computation, it's a simple enough exercise. If we were to sell shares, we want to know the proceeds and we want to know our allowable costs to be able to work out the gain or loss that arises. Two figures, therefore, primarily that we need to establish. First of all, the top line disposal consideration. Well, if they're sold at full value, it's sales proceeds. But if there's any element of gift, of course, then, as we already know, you must use open market value. And when it comes to the disposal of shares, that market value would be given to you. If you're dealing with unquoted shares, those values, the price would be given to you. But if you were dealing with quoted shares, as we saw in our previous chapter, our first chapter on CGT, then you may be expected to apply the valuation rule that exists there, which is where they tell you at the close of that day upon which the gift took place, here were the closing prices. And there's two prices, and you take a simple average of the two. The mid price is what you take. So, in terms of getting the disposal consideration, it's simply enough. Either it's the figure given within the question for unquoted, or if they don't give it to you again for quoted, then they would give you the closing prices on the day and you take the mid price. But the real problem when it comes to calculating gains on shares is cost. Now, we made this point in the previous chapter that if you're likely to see any real problem in calculating a gain, it's about determining allowable cost. And so it is now with shares. When we sell shares, as I say, we'll know what we sell them for. And if we give them away, then we'll know what the market values are. But when you sell shares, it is not necessarily just one lot of shares that are sold that you had originally bought at a single point in time and at a single price. The chances are that the taxpayer that you're dealing with may have accumulated his current shareholding in a company over a period of time and over a series of acquisitions. So we might have bought some of these shares now sold 10 years ago, some 6 years ago, some 4 years ago, some 2 years ago, some a few months ago, some maybe a week or so back. And now we sell some, but not all of those shares. So the question arises as to when we sell some but not all of the shares in a company that we own, what costs should we use? Should we use the cost of the shares that we bought first 10 years ago, or 8 or 6 or 4 or 2 or 6 months ago, or whatever? What cost do we use? Now, of course, HMRC do not then leave that decision up to us. What they have here in Note 1.2 is a set of rules by which we determine which shares are being disposed of. So, what are those rules in terms of the shares firstly deemed to be sold? Right, the first two are very specific, and one or other of these may arise within a question. One of them looks quite odd indeed, but it's the third category where most of your work, if not all of the work, will be involved. But to begin with, when we sell shares, which shares are deemed to be sold first? You need to know that to know what the cost is to put against your sale proceeds. First of all, any shares acquired on the same day as the sale. If you have both bought and sold on the same day, you match that sale with those shares bought. Probably in the exam question, that's the least likely to see. We occasionally do get the second one, mainly because it's an odd one. Shares acquired within the 30 days following the sale. So that is an odd one. We're actually deemed now to be selling shares that we haven't yet acquired, but we go on to acquire in that company within the 30 days following the sale. Now, why we have that strange rule? You think, well, if you've got shares, surely you sell them. Why would you relate them to shares that you've not yet bought that you go on to buy within the next 30 days? There is a reason for that. I'll explain that to you later. But at this point, it's just a case of learning the rules. So, shares bought on same day, shares acquired within the 30 days following the sale, but then where most of your work will come from, shares from a share pool. So that rather than matching shares on something like a first in, first out or a last in, first out basis, we do it on an average basis. That when shares are acquired, they are placed into a pool. So we will average out all those purchases at all those different costs, so that any shares sold from that share pool will be taken out at an average cost per share for all of the shares within the pool. It seems like a perfectly reasonable basis to use. They'll come out on an average cost. So we use a share pool. It's a weighted average basis to determine cost, rather than something like first in or last in, first out. These matching rules are in fact different from those that apply to companies, but again, as we said, at the moment we are dealing with individuals, not companies. Corporate tax and capital gains await us later on in our studies. So most of the work on the share pool. Now, it is a simple enough exercise to construct the share pool. All you need is two columns on the right hand side of your page, listed number of shares and cost of shares. And as shares are acquired, so we put in how many shares into the number of shares column and any cost that may be incurred into the cost column. Now, the numbers of shares will include, well, as you'd expect, all acquisitions. Now that brings in, and it's very likely to involve one or other or both of these types of issue that we'll see in a moment, that we will have to deal with either a bonus issue of those shares by the company or a rights issue by the company, possibly indeed both of those. So when you acquire shares, it's not just that you purchase those shares. It's not just that maybe you are gifted those shares. The company may issue more shares based on your existing shareholding. Now, hopefully these terms you're familiar with from your accounting knowledge, but bonus issues are where the company issues free shares on a proportionate basis to your existing shareholders. On the proportionate basis to the existing shares held by those shareholders. So a bonus issue might be the company issues one new share for every 5 shares that you own. Now, if they're free shares, why are they doing it? Well, that's got nothing to do with tax. That's purely an accounting issue. They're basically rearranging the capital section of their balance sheet. Again, if you don't mind me using the old balance sheet expression rather than, what is it, statement of financial position, I think they call it these days there. You don't have to, again, understand why they may be doing it. All you've got to do is deal with it. Well, that's simple enough. There's a number of shares now being issued that you need to work out. So if I currently own 5,000 shares and there's a 1 for 5 bonus issue, I get issued with another 1,000 shares. Put it in the number of shares column, but there is no cost because these are free shares issued. More interesting is a rights issue, and probably you'd think more sensible. Rights issues are where a company seeks to raise new share capital, but of course who does it go to first? Its existing shareholders, and it attempts to tempt those existing shareholders to buy some new shares because it offers the existing shareholders the right to acquire again on a proportionate basis, like 1 for 5, 1 for 3, 1 for 1, well, probably not as high as that, but whatever it may be, on a proportionate basis, these additional shares in the company. And how do they tempt us with that? With an advantageous share price. So we may have to deal not just with normal purchases of shares from third-party existing shareholders in the company, but the company itself may issue more shares in the form of either bonus issues or rights issues. With a bonus issue, just add the extra shares acquired into the number of shares column, and with a rights issue, add in the extra number of shares. So if the rights issue now was 1 for 5, you got on 5,000 shares another 1,000 shares acquired. But it might be a rights issue 1 for 5 at £10 per share. So you get another 1,000 shares at £10 per share. So that's an extra cost of £10,000. Put it in your cost column. When eventually you come across a disposal, then the shares disposed of from that share pool will be disposed of at their average cost. So you will have a total of the number of shares at this point, a total cost of those shares at this point, and you will take those shares sold now out of the share pool on an average cost basis. Now, this share pool is an easy thing to establish so far as an individual is concerned, because it is just listing out the number of shares acquired and the cost of shares. That exercise becomes a little bit more interesting, where also when dealing with corporate tax and chargeable gains, you have to compute and put together a share pool. But for companies, as we mentioned, we don't yet know what it is. There is relief given for the effects of inflation, known as indexation, and that needs therefore to also be recorded upon the share pool. So you'll have a third column in addition to the number of shares and the cost of shares, which we have here now for individuals. There'll also be an index cost column, which will include both the cost plus the indexation allowance as it is known. But that awaits us later on. Let's though look at a basic example in terms of example 1, where they're asking us to calculate Jane's capital gain on the disposal of the shares in 2017. So we look at the way in which Jane has acquired shares over the time from the very first acquisition through to this date of disposal. So what are we told? Jane owned shares in ABC Limited. She acquired some 1,500 shares in the company on the 31st of May 14. And there's the cost, £20,000. Another 500 shares, June 15. And again, a different cost, £10,000. And then, critically, given the date of the sale of the shares, the 28th of February 17, Jane also there had bought on the 7th of March 17 a further 200 shares in ABC Limited for £4,000. Now, why is that such a critical date? Well, remember the rules that we go through. First of all, we match this disposal with any shares acquired on the same day. Well, the disposal was the 28th of February. Is there any item in that list of acquisitions dated the 28th of February 17? No, there isn't. Therefore, no acquisition on same day. So that's that one out of the way. But why that 7th of March of 17 was an important date is, of course, that there is an acquisition in the next 30 days. So that, therefore, is going to be our first port of call. Now, that particular acquisition was dated, as we know, the 7th of March 17. And there were some 200 shares that were acquired on that same day. So that 200 shares, they're the first to go. Out of the shares sold here, that sale was 1,000 shares on the 28th of February 17. The first of them to go is 200 shares. So a normal disposal calculation, therefore. So what have we got? Our disposal consideration, as we call it, our sales proceeds. If I can get this to move down, there we go. Our disposal consideration, sales proceeds. This is 200 shares
out of the 1,000 shares being sold at what were proceeds of £25,000. So 200 of the 1,000 at £25,000 for the lot will give us therefore our sales proceeds in this particular calculation that methinks will be some £5,000. What was the specific cost of those shares? £4,000. Cost £4,000. Take it away, and as we can see, we have a gain there of £1,000. Gain £1,000. Okay, so that's the first part of the process. Check to see were there any shares now sold that were acquired on the same day. Here, 28th of February 17. No, there weren't. So move on. Were there any shares acquired in the following 30 days? Yes, on this occasion there was. The 7th of March 17. So we will allocate therefore that 200 shares to this disposal. We had sold the 1,000 shares for £25,000, so 200 of those 1,000 would have therefore had that value of £5,000. Take away the specific cost, 4,000, and we've got the gain of £1,000. That means, having accounted for 200 of the 1,000 shares sold, there is a further 800 shares that now we must establish the cost of, and use that cost in a similar gains calculation to what you've seen there. Where's that cost going to come from? It's going to come, of course, from the share pool. It'll come from the share pool there, and that's our next working that we need to put together. Okay, so over the page, well, for me anyway, you'll need to keep an eye on the information in the question so that we can put together this share pool. So we set it up. Thirdly, share pool. Now we said that there were two columns that we need to run here to record. Firstly, the number of shares either acquired or disposed of, and to record the cost of those shares. It is not within the share pool that you calculate the chargeable gain. The chargeable gain will be a separate computation. The share pool is a means to that end. It will provide us with the cost of those 800 shares that now we have to account for. We sold 1,000, 200 we've worked out the gain on, the remaining 800 come from the share pool. Okay, so we look therefore at each of the acquisitions. The first of our acquisitions, which I think there was, but check the date to save me scrolling back, the 31st of May 15, we had 1,500 shares acquired at a cost of £20,000. Very easy process. Again, just write it in. If, of course, you're doing this in an objective testing question, you don't even have to worry too much about your presentation either, but do make sure it's clear to you what the information is. There's your first acquisition. Second of the two acquisitions that went into this pool was at the 30th of June there, I think, 15. That was a further 500 shares, and there's an additional cost of £10,000. So at the point of disposal in February 17, there were within the share pool some 2,000 shares that had a total cost of £30,000. Now we can deal with the disposal. Remember, it's a pool, so we take out the share cost on an average basis. So here, therefore, was it the 28th of February 17, I think, we have our disposal, and some 800 shares of the 1,000 shares sold come from the share pool. So we're taking out 800 shares from the 2,000, not that would be interested in the remaining figure, but that would leave 1,200 shares in there. So we now have got to take the proportionate amount of share cost. So we're selling 800 out of 2,000. So what we want here is 800 out of 2,000 times what is the total share cost at that date? £30,000. Put that through the calculator, and that hopefully will give you £12,000. Now, for future purposes, not that we need it again here, we now know that there remains within the share pool 1,200 shares, and they have an allowable cost of £18,000. But there is the critical information that we now need, and that was the purpose of the share pool. We now know the cost of the shares being disposed of from that share pool. So to calculate the gain, normal rules, sales proceeds, well, it's the other 800 of the 1,000 shares sold for £25,000, and that, if you'll allow me to just sneak it in here, so I've just got enough room to put it in, that will be the remaining £20,000 of the proceeds. And your cost, of course, as we know, we would see the share pool, or working 1 or working 3 or whatever you want to call it, of course, in your exam at this point, if it's in a written question. Otherwise, you just need the information. And what you know is, there is your cost, £12,000. £12,000, take it away, and we are looking at a gain of £8,000 on those shares. Now, of course, the overall gain that we're talking about will be, if we just wind this back, on out of the 1,000 shares sold, it was one disposal. We made £1,000 gain on those that we went on to acquire in the following 30 days. And then, of course, we made a gain of £8,000 on those shares that came from that share pool. So there's a gain of £9,000 in total to include within the CGT computation for our taxpayer for the 2016-17 tax year. Okay, if needs be, take a moment now to have a little look through the answer to that in the back. Make sure that you are okay with it. But otherwise, now we move on. Now, you will recall from a few minutes back, we said that other ways of acquiring shares in a particular company, other than just buying those shares from other existing shareholders, is to take advantage, if that's the right word, of either a bonus issue or a rights issue from the company. Now, bonus issues, as we know, is just free shares being issued by the company, not to do us any favours, but of course just to rearrange the, as we said, capital section of their balance sheet, again, as we call it, well, as I call it anyway. So bonus shares increase the number of shares held with no corresponding increase in cost. So it's ever so easy, therefore, to deal with, because all we've got to do is set up our share pool and add in, like we would with any other acquisition, the number of shares that we have acquired, but of course without the need to put in any cost, because there isn't any. So it's just another add-on to the share pool. Let's see very quickly how we do that. Nice simple exercise. We've got to calculate the gain on a disposal in October 16. There's our October 16. Now, looking around that date on the list of the shares acquired, we can very quickly and very easily see there were no shares acquired on the same day, and there were no shares acquired within the following 30 days. Therefore, all we need is our share pool. So we put together our share pool. Now, you should therefore be able to do this for me, because we can see there's the first acquisition, there's the second acquisition, and based on then the total number of shares held as at July 15, we have that bonus issue of 1 share for every 5 shares held. Now, if you want, do pause at this particular point in time, because hopefully you should be able to work it through from that point on your own. Or otherwise, stick with me and I'll just take you through that now. But again, pause if you so choose. Right, so for those of you with little faith therefore in your own abilities, let's just see what we've got. All right, in this share pool, we've got February 15 acquisition. 7,000 shares, cost £15,000. June 15, we've got another acquisition here. This time, 1,000 shares for £4,000. It's a pool, so we add it up, at that date we own 8,000 shares in the company that in total have cost us £19,000. Then the, well, slightly more interesting bit. In October 16, we have a bonus issue. The bonus issue, 1 share for every 5 shares held. 1 share for every 5 shares held. 8,000 shares at the moment, divide by 5 is, I think, 1,600 shares. And of course, there is no cost. It's a bonus issue. So all it means is that the share pool now consists of 9,600 shares in this company that are still deemed to have cost £19,000. So we can then move on to the date of disposal, October 16, where we had our disposal. How many shares? Sold 5,000 shares. 5,000 shares. Well, I don't know, we can probably do this one in our heads, but if you get your calculator out there, we are selling 5,000 out of 9,000 with an overall cost of £19,000. Put that through the calculator and, well, hopefully, if my calculator is correct anyway, that gives you an allowable cost here of £9,896. In reality, of course, you then see what your remaining shares were and what they cost, but if all you've got to do is to compute the chargeable gain, there's no need to be worrying about crossing the T's and dotting the I's, as we say, and establishing what that balance is. What we can now do is to use the information we found, and that's the figure there, in calculating our chargeable gain. Now again, we'd write it out properly. If we were doing a written question, it's sales proceeds. What did we sell for? It was £20,000. What was the allowable cost? It was £9,896. So what therefore is the gain? All being well, 10,104. Again, if you were doing this in an objective testing question, you wouldn't be writing this out. You would simply, on your calculator, pick up 20,000, the figure you can see in the question, from what you computed in your workings as the cost, 9896. There's nothing to write out. It's a quick and easy exercise for you, therefore, to perform. So, bonus issues shouldn't, I hope, therefore be a problem, because it's ever so easy. All you are doing is just adding in extra shares to your share pool. Okay, on we go. We said, of course, that at least slightly more interesting than the bonus issue is the rights issue. Now, the rights issue. There, what we've got, the share pool, again increased by the number of the shares, but also this time the cost of the shares acquired via the rights issue. Remember what the company is doing here. It is choosing to go to its own shareholders first to raise additional share capital. How do they tempt their shareholders to part with their hard-earned money? By ostensibly offering those shares at an advantageous share price. Well, what we've got to do here in example 3 is to work out the gain arising on the sale of 6,000 shares for £24,000. Again, the quick check to see, as you would in the exam question, were there any other shares acquired on the same day? No. In the following 30 days? No. So in which case, therefore, it's as we were before, we've got to put together our share pool. So our share pool working, number of shares, cost of shares. What was first up? February 2015. It's an acquisition. 6,000 shares for £15,000. On again to June 15. Again an acquisition. 900 shares. £2,700. Now we've got a pooling. What did we have at that date? 6,900 shares with, of course, a total cost of 17,700. Ever so easy, isn't it? And then, in when was it? July 15, we have the rights issue. Now, just like a bonus issue, it's based on the number of shares that we currently own. This time we were told up here it was 1 share for every 3 shares held, but as a rights issue we paid to acquire those shares, and that was at a rate of £3 there per share. So 1 for 3. Divide 6,900 by 3, and that therefore means we acquire a further 2,300 shares at £3. 2,300 at 3, £6,900. Revise your share pool, 9,200 shares, methinks, at what is an overall cost of £24,600. That's the position at the point at which we had the disposal. So again, it is a pool. So in, where was it, September 16, disposal. Again, all of this written work that you see me scribing down here, you've only got to do that, of course, if it is a written question that you're dealing with, which, well, it may be, but otherwise it is an objective testing question. You'd have just put this information down here. Again, that's what you needed to know. And now the disposal. How many of their shares are being sold? 6,000 shares. 6,000. Therefore, 6,000 out of 9,200 shares in the pool times, what was the allowable cost? 24,600. Now again, you please do put that through your calculator just to check, in case my maths have not served me well. But hopefully we make that figure £16,043. Again, you'd take it away and revise the share pool balance if you were moving that forwards. We don't need that. All we need to know was that information. The share cost was £16,043. Therefore, in your gains calculation, if we had to write it out, we would have sale proceeds, £24,000 we were told. There we go, 24,000. Cost, reference to our share pool, 16,000 and what's that, 43. Take it away, so we're looking at a gain, all being well, of 7,000, what's that, 957. 7,957. So again, bonus issues, rights issues, therefore, the other two ways by which we might acquire shares in the company without actually they're going and buying from an existing shareholder, but acquiring them either free or by purchase directly from the company. Either way, they impact upon the share pool. Once you've got your share pool, as at the date of disposal, how many shares come out the pool, and work it on an average cost basis, and therefore the job is done. Again, take a little look through, make sure that you are happy with that. Look at the model answer at the back of the books. And what we will then be looking at next time, but probably the only sort of complication, as some might view it, in relation to dealing with shares, I would call it not a complication, but the more interesting bit, and that is when dealing with takeovers. The situation that you have there is you go out and you buy shares in A PLC. But along comes V PLC, and V PLC takes over A PLC. And what do? They do it on a share-for-share basis. If V PLC paid you money, you've just made a disposal. What's your cash received? Your proceeds, and therefore you can calculate the gain in the normal way. What makes these takeovers interesting from our perspective, and therefore from the examiner's perspective, is that we will be dealing with what we call a share-for-share exchange. That we will effectively be swapping the shares that we had originally bought and at this point own in A PLC, and instead acquiring shares in V plc. So at that point, we're swapping one bit of paper for another. Therefore, at that point, there is no immediate gain that arises. The problem will arise in terms of calculating a gain is in the future when you decide to dispose of some, if not all, of your shares in V plc. What you will want to know is what was their cost, because you didn't buy them. What you bought was shares in A. Therefore, it's not a difficult exercise, is it? Whatever was the cost of the shares in A, that cost is now acquired by the shares in V. We are said to have the V shares step into the shoes of the old shares, the A shares, and acquire their cost. Well, more of that with examples, of course, in our next and final indeed session on this particular area of shares in CGT for individuals. But check out the answers to the problems we've done. Make sure you're happy with the technique. Shouldn't be too tricky, I hope. And then we'll move to, as I say, the more interesting part, and that is dealing with takeovers. We look forward to talking to you again then.